Hello and welcome to the Wealth Approach podcast. I'm joined by Megan Kowalski this month. And Megan, let's walk through the Fed surprise jumbo rate cut, maybe talk through some of the implications and what to look for ahead.
Definitely. So I think most people were pretty surprised by the announcement yesterday. Even though the prediction I think still going into that day was around 60% that they would um, cut rates by 50 basis points as opposed to 25. Still, the underlying tone of the market was really more of a 25 basis point they thought would be realistic. So to get the 50 basis point cut was somewhat of a surprise, potentially to the upside, but time will tell. Um, we took a couple different snippets from yesterday. One being that yesterday was the first time there wasn't a unanimous decision on 50 basis points as opposed to 25, where just basically all the Fed governors weren't unanimous in the decision to do that since 2005. So that was the headline that was surprising. Again, to our point, I think what was surprising that there was only one dissent and not more, that there was so much of them unanimous at 50 basis points, since that wasn't really the tone up until literally yesterday. Um, so that was just something we wanted to point out. The other was, they kind of just mentioned that they're recalibrating their policy based on current conditions and that it's in a much better spot. They're obviously not focusing as much on inflation anymore and much more on jobs and making sure they don't see continuing weakness there. Recalibrate was the word of the day. That was quoted almost, I think it was over 10 times potentially. So too soon to tell if that's going to be the new transitory or pivot, but that was definitely a hot word yesterday. So we'll see if that's going to be, the it word that they use as to why they're making their decisions moving forward.
Well, and when you think about this, Megan, the question is why did the Fed change so quickly to go 50? When you look
Right.
historically at a cut like this, which is viewed as an aggressive move, normally a 25 basis point is a policy adjustment. This one's a little more aggressive. Why did they change? What does it mean compared to history? Because in general, when the Fed is in a cutting cycle, they're usually trying to protect a slowdown in the economy, right? There's either
Mhm.
been a lot of weakness in data, but you don't have that currently. We had 3% GDP growth in the second quarter. Right now, with less than 2 weeks to go, based on the Atlanta Fed projection, you're 2.9% GDP. So there isn't a real big slowdown to be concerned about at this point. So compared to history, a move like this, and the Fed, to your point, using recalibrating, they're looking at this a little differently than protecting the economy, at least at this point. Because one of the concerns coming into yesterday is if they did do an aggressive move of 50 basis points like they did, that the markets would sell off thinking the Fed was concerned about the economy, right?
Mhm.
And they've done a pretty good job in the short run of repositioning the thought to the labor market and saying policy was too high and too restrictive, that they needed to be aggressive to get ahead of the labor market and bringing rates down quicker with a path to much lower rates ahead. So maybe if we look at some of the historical context as to why the Fed. So here's the big concern that the Fed has right now is the labor market. So when you look at the lines, you have the unemployment rate, you have the Fed funds in blue, and you have consumer prices. So you could see, the green from 21 as that was increasing, inflation was going up. As inflation was increasing, you could see the Fed was a little delayed to adjust and slowly move up rates. And they
Mhm.
continued to move up rates as inflation was moving lower overall. And then they've held rates, at the 5.5% level for the last year plus, despite the fact that inflation was trending lower and has trended lower. On the other hand, the unemployment rate continues to trickle up, and the job creation per month the last few months has really slowed down. So, the Fed is really trying to pivot toward, we're not concerned about inflation. We believe we're headed back to that 2% target. We're protecting and concerned more about the labor market at this point. And again,
So this is the scenario that they're kind of arguing roughly as to why they're focusing on the 50 basis points as opposed to 20. But another theory could be slowing GDP. So, and this isn't something they're going to openly say, but this is kind of one thing that you noted that they might also be looking at and keeping an eye on. So if you want to go into that.
well, and if you look, Megan, it's hard to tell the blue lines, those little adjustments, 2017, 2018, the
Hmm.
Fed was increasing interest rates. You could see inflation was, GDP was running fine and consumer prices were a little bit elevated. But then if you look at the end of 2019, before anyone knew COVID was going to have the impact it did, the
Hmm.
Fed was already lowering rates a few times going into COVID because if you look at the green line, they anticipated that slowdown and were trying to adjust policy accordingly, thinking the economy was going to slow down, not knowing, COVID was ahead. But you could see during COVID, with the recession that was the 2 quarters and the huge impact, they went to zero interest rates. So that's normally what you see the Federal Reserve doing is they're proactively cutting interest rates, trying to protect the economy, overall. So that it begs the question, is the
Hmm.
Fed really concerned about a slowdown in the economy ahead? Or is it really that first scenario that, has kind of been coined the Goldilocks scenario, where they can slowly lower interest rates, the economy holds up, the labor market holds up, and inflation trends back to 2%, right? And that's the big thing investors are trying to figure out. In the short term, it's hard to tell. There's a lot of computer trading, there's a lot of volatility, right? You need some more data points over the next, few weeks and months ahead to confirm where things are moving. But, one big concern you have with the Fed being aggressive, and if you do have that first scenario play out, Megan, it's, is it going to be too big a move? Is there going to be a lot of activity, too much exuberance, and you
Hmm.
could have some inflation concern ahead?
Definitely. And that's something they are looking to avoid, which is, I think, why again, the 50 basis points was a little bit of a surprise, um, based on the aggressive move. However, if you look historically, kind of scenario three as to why they might have done 50 as opposed to 20 would just be that it is pretty in line with Fed policy decisions in a rate cut cycle as opposed to a rate hike. So typically there's more of a stair step up and an elevator down. So it might be a little bit choppy and less consistent with how often they're cutting, but they might be taking more of the elevator down, and that's kind of in line with what you've seen historically when when they're pulling down rates. So that's another potential scenario. We'll have to see over the next couple meetings what
Well,
really plays out there.
and to your point, Megan, if you look at this graph over history, all those shaded areas are the recession.
Hmm.
And when you look at the Fed, they're cutting rates usually before the recession happens, trying to mitigate the slowdown. And to your point, once you're in the recession, they're aggressive at cutting rates. So at this point, they don't foresee that, and we don't believe that's the case as we enter this rate cutting cycle. But this is what they're trying to proactively
Avoid.
avoid.
Yeah, definitely. The only potential issue and something we talk about often is time will tell. We're not going to know for a while if this rate cut was too soon, too late, too much, not enough. The problem with rate cuts and Milton Friedman, obviously, we followed him with Gene's history with him in the past, but he was quoted in talking to Congress that it's like a water tap that you turn it on now and it only starts to run 6, 9, 12, 16 months from now. So that's just to say we're not going to really know the real impact of this specific rate cut or even continued rate cuts for the next couple quarters for a while. And so it's again just kind of time will tell and we'll see if that soft landing is in the cards for us.
Well, Megan, one fun fact I think when you think about a big picture, who's the biggest beneficiary of the rate cut yesterday? The answer is taxpayers and the US government, right? With 20 to 30 trillion of debt and a lot of it being short term, as the
Hmm.
Fed cut interest rates, the cost to carry and refinance that debt goes down proportionally. And that's a lot of savings of interest cost, to the US government and to ultimately taxpayers overall. So it's interesting to see the impact because there's a lot of discussion around how much debt and concern around that. But
Hmm.
as the cost of that debt goes down, it becomes less of a concern as well.
Definitely. And
What
then if
one of the
you go ahead.
one of the big challenges now with what we are just talking about, as the Fed cut aggressively and looking ahead, plans to cut another two times by the end of the year, and market expectations are another seven cuts over the next year. What happens to mortgage rates and debt overall? Because a lot of people were surprised to learn that the Fed cut interest rates 0.5%. Mortgage rates actually went up yesterday, which is counterintuitive. How does that happen? If the Fed cut 0.5%, I would have expected mortgage rates to come down. So why didn't they? And the reason is that the Fed controls very short-term interest rates. Supply and demand control the intermediate and longer term rates. And
Yeah.
a lot of this was priced in ahead of the Fed rate cut, even though it was more aggressive. So it's kind of the challenge looking ahead. And the question will be, will the lower rates ultimately lead to real economic activity to stimulate? And housing is, I've talked about this last couple of years, we've pretty much been in a depression as far as real estate activity, right? It's been such a low, low level. And if you look at this chart, purchase activity for mortgages was elevated with all the activity and multiple offers and how hot the housing market was in 2020 and 2021. But look at the purchase applications today. Despite the fact that mortgage rates have come down fairly dramatically relative over the last month or two, very little pickup in demand and activity overall. So one thing to watch for looking ahead is there's a lot of conversation. If you talk to any bankers, mortgage brokers, you name it, a lot of people have reached out, with the lower rates, but it hasn't translated to a lot of activity yet.
Well,
And
and
one
I
of the,
think there's a difference in activity that you're noting because there, especially even yesterday, I mean, we were getting calls with advice on this, but I would say there's a lot of activity interested in the refi market, but you're talking about real activity with with sales and home purchases, and that's a big difference that it still probably will take a little bit more for those numbers to come in line for families for the overall affordability of certain properties to get closer to where they need it to be because it's been so elevated, taking everything into consideration.
and you look at the reason, one of the major reasons why, Megan, is if you look at the effective rate of all existing mortgages, it's around 4%. So if the
Hmm.
going rate of mortgages is 6%, you still have that trade up effect that if I'm going to give up my 3 or 4% mortgage to move up, it's still six. It's better than 7.5, 8 where it was, but you still have that 2% gap to justify the higher cost. You have higher taxes, higher insurance still. So the question will be, where is that middle ground? Is it 5.5 for mortgages? Is it five? And that's the buildup of expectations going into next year is as the Fed lowers rates, will it be like yesterday where there's very little impact on mortgage rates? Or the optimistic scenario is one of the challenges banks have faced over the last 2 years with having to pay depositors 5%. It's restricted their ability to be aggressive and make loans because there isn't a lot of demand for loans at 8, 9, 10%, which is what a lot of the banks needed to kind of maintain their spread. So as the Fed lowers the funding costs, it'll ease the burden, potentially on a lot of banks to allow them to extend capital, maintain their margins, and bring down rates for the overall economy to increase demand to see purchase activity and other things pick up the next year or so.
Definitely. Oh, went too soon. But something kind of along those lines when you said the demand for um, loans at higher rates, that's kind of that small business activity that's again been, well, all business, but especially small business activity that's been a little quiet lately just because they don't want to take on that risk. Lowering rates should help stimulate small companies again. So we should see a little bit of that pickup. It could just take some time again for that to flow through. But if we're looking at who could benefit from these rate cuts categorically from the stock market perspective, it's going to be smaller companies, companies that are paying dividends or higher dividends. So that's something we're looking into from a bond market. This is where it's again a little bit different than kind of historical because we have an inverted yield curve currently and it's been inverted for so long. Um, but most of the time, this would impact longer dated bonds and lower credit ratings because it's been inverted. We're going to have to see how long that will take to trickle through what we would kind of say like as textbook or normal scenarios to play out. So we'll see how the bond market reacts to this over time. But right now, it's, just starting to digest this news. So we're keeping an eye close on that. And then the real estate market, again, we're already, hearing whispers of definitely a pickup in refi activity. It's just how quickly are the buyers going to come back to the table and sellers be willing to do that trade up that you're talking about? Because 2% doesn't sound meaningful, but it adds up quite a bit to your overall monthly payments. So if they're making the move and they're having to trade down to make the move, those numbers have to get a little bit more in line for those scenarios to play out, and that will help bring demand back in the system so that we can see more purchase activity.
Because the question on many people's mind, including ours, is where do you go, right? A lot of news, a lot of activity. And when you think about the cycle we're in, it feels like we're entering what I've been calling kind of a boring market or boring economy, where
Hmm.
growth rates are slowing down. The Fed is cutting interest rates overall to mitigate, a potential slowdown ahead. That's up for debate now that they started a little more aggressively, because the impact you could kind of get yourself out of a boring market if you pull a lot of cash from the sidelines, create a lot of activity, and you could have an economic boom ahead. But then
Hmm.
what's the cost of that? That could be future inflation and other things to be worried about next year and beyond. If you do have that, at this point, thinking about the boring market, if that's the case, and boring again being defined as, slowing growth, inflation coming down, the Fed cutting interest rates, slowing labor market. That's where valuations looking currently in beyond into next year. The high multiple stocks could easily come lower with those lower growth rates and such. And you're going to want to look at rebalancing your portfolio, look for the opportunities that directly benefit from the lower rates. And looking at companies with floating rate debt, for example, you immediately get the cut, just like the US government on their short-term debt. There's a lot of impacts to asset classes like that that are interesting overall. So these are the things I think short-term to be aware of and monitor. And with that, I want to thank you for tuning in this month. And if you have any questions on the impact of interest rates on your planning or your, kind of family estate overall, feel free to reach out and we'll touch base next month.
Thank you.